Did you know that a mere 1% difference in ETF fees could cost you over $100,000 in the long run? That's just one of the shocking secrets we're about to reveal. Get ready to discover 6 dirty ETF secrets that Wall Street has been hiding from you. Your financial future might depend on it. Imagine the investment world as a complex game of strategy. ETFs are your star players, promising diversification and easy access to markets. But what if I told you there are hidden traps and secret moves that could make or break your success? Today, we're pulling back the curtain on Wall Street's playbook. You're about to learn 6 dirty secrets about ETFs that the big players don't want you to know. These aren't just minor details, they're game changers that could be the difference between financial struggle and prosperity. Are you ready to see the investment world through new eyes? Let's dive into the hidden world of ETFs and unlock the knowledge that could transform your financial future. Now that we're diving into ETF secrets, let's talk about the silent wealth killer lurking in your portfolio. Have you ever wondered why your investments aren't growing as fast as you expected, despite following expert advice? The answer might be hiding in plain sight, and it's costing you more than you realize. Let's uncover the first dirty secret: the hidden impact of fees on long-term returns. Picture this: you're diligently investing in ETFs, thinking you're on the path to financial success. But there's a catch. Even small differences in ETF fees can snowball over time, potentially costing you hundreds of thousands of dollars. It's like a tiny leak in a boat, barely noticeable at first, but over time, it could sink your financial dreams. So, how do you plug this leak? The key is to become a fee detective. Make it a habit to perform annual portfolio checkups. Ask yourself, can I find a cheaper ETF that serves the same purpose? Is my broker offering competitive prices? Remember, every dollar saved in fees is a dollar that stays in your pocket, working for your future. Now, let's sail into even murkier waters. You've probably heard that diversification is the holy grail of investing. But here's the second dirty secret. Owning multiple ETFs doesn't guarantee true diversification. In fact, it might be giving you a false sense of security. Imagine you're building a shield against market storms. You think you've got it covered with multiple ETFs. But if these ETFs are highly correlated, meaning they tend to move in the same direction, your shield might have some serious weak spots. During market downturns, you could find yourself more exposed than you ever imagined. So, how do you build a truly diversified portfolio? It's not about the number of ETFs you own, it's about understanding what's inside them. Look beyond the surface and dive into the underlying assets of each ETF. Are they all invested in the same sector or region? If so, you might be putting all your eggs in one basket without even realizing it. Remember, just because an ETF contains more than one underlying position doesn't mean that it is immune to volatility. You need to be aware of each fund's focus and the types of investments it includes. It's like being the captain of your own ship. You need to know every part of your vessel to navigate safely through financial waters. Just as a ship needs more than just a sturdy hull to weather a storm, your investment strategy needs more than just diversification. What if I told you that the biggest threat to your financial future isn't market volatility, but something much closer to home? Let's dive into the murky waters of investor psychology and uncover a secret that could change the way you approach ETFs forever. The third dirty secret of ETFs is the destructive power of emotional investing. Your own brain might be secretly steering you off course. Fear and FOMO, fear of missing out, often lead investors to buy high and sell low, eroding returns over time. It's like being caught in a riptide. The more you panic, the further you're pulled from safety. Humans are hardwired to follow the crowd, making it challenging to resist the urge to invest when prices are soaring. This herd mentality can lead to poor timing and potential losses. Imagine everyone rushing to one side of a boat. It might feel safer, but it's actually increasing the risk of capsizing. So how do you stay afloat in these emotional waters? The key is maintaining emotional discipline. Set clear investment goals and stick to a long-term plan. Think of it as charting a course before you set sail. It helps you stay on track when the seas get rough. But even if you've mastered your emotions, there are still hidden dangers lurking beneath the surface. Our fourth dirty secret reveals that some ETF products, while seemingly safe, can be ticking time bombs in a long-term portfolio. Leveraged and inverse ETFs, for example, are designed for short-term trading and can experience significant value decay over time. Understanding an ETF's structure and holdings is crucial before investing. It's like checking your ship for leaks before a long voyage. For instance, many investors assume short ETFs will deliver positive returns during market declines, but they're not designed for long-term holding. Now, let's navigate to our fifth dirty secret: the hidden tax implications of ETF investing. Did you know that capital gains distributions from ETFs can create unexpected tax liabilities? It's like discovering hidden fees after you've docked your boat, surprising and potentially costly. To avoid these tax traps, consider tax-efficient ETF investing strategies. Look for ETFs that minimize capital gains distributions and consider holding them in tax-advantaged accounts when possible. We've uncovered 5 shocking secrets about ETFs, from hidden fees to diversification illusions. But there's one more bombshell to drop. Did you know ETFs aren't always perfectly priced? That's right. Sometimes their market price doesn't match their true value. This gap creates opportunities for smart investors who know where to look. So, what's your game plan now? Stay sharp and keep learning. Regularly check the difference between an ETF's market price and its net asset value. Be aware of liquidity issues in thinly traded ETFs, and always stay informed about changes in your ETF holdings. You now have insider knowledge that could revolutionize your investment strategy. By understanding these ETF secrets, you're not just playing the game, you're changing it. Remember, in the world of investing, knowledge truly is power. Use it wisely, and you might just outmaneuver Wall Street at its own game.